Hi everyone, in today's video we're going to look at understanding the capital stack. So in order to do that, we first of all need to understand what do we mean by that term. So within the context of property development, the capital stack refers to the different sources of finance that have been used to fund that deal. Not only that, but the structure in which they're held within the deal. Within the capital stack, we have two main sides, one being the equity and one being the debt. So let's have a look at that in a bit more detail. So the first layer within our capital stack is the debt layer. Debt refers to any finance that has to be paid back with a fixed interest rate within a fixed time period. Our debt could be most commonly our development finance, sometimes referred to as our senior debt or our construction loan. It could also be things like a mezzanine facility or a bridging loan. And in more normal terms for property, it's what we'd refer to as our mortgage. Debt typically takes up the largest amount of our capital stack, and it can be made up of first and second charge lending. So in the context of property development, the first charge would be the senior debt or our development finance, and the second charge would be a mezzanine facility or some private debt coming in to top up the senior debt. So what do I mean by a charge? So in the context of property, a legal charge means a legal encumbrance on that property that secures the interest being the repayment of the debt. When a property has a charge on it, the charge must be satisfied prior to the property being sold or transferred. So to put it in simple terms, if you had a house that had a mortgage on it, the mortgage for £250,000, but the house was sold for £500,000, before you as the seller received anything, the first charge must have to be settled, which means the £250,000 to the bank would have to be paid off, and then you would receive your £250,000, making up the total sale price of £500,000. If you had a first and a second charge of £250,000 and let's say a further £50,000, the exact same thing would happen. The sale would proceed, the first charge would be cleared, leaving us with £250,000 after that's been cleared. The second charge would then be cleared after the first for another £50,000, leaving you as the seller with £200,000 after all legal charges have been cleared and settled. The second layer is our equity layer, and equity refers to an ownership stake that an individual or group has in that project. Now, when someone invests equity into the deal, they are doing so with the idea of getting a profit share on the back end or a part ownership of that deal. Within the equity layer, we can also have preferred equity, and preferred equity has priority in payout over common equity in a deal in the event of liquidation or sale. Preferred equity is most commonly going to be confused with debt when people are talking about the capital stack, and this is because preferred equity can be offered with a rate of return and a detailed buyback structure within the shareholders agreement, and in doing so it can act similar to debt. However, it is still very importantly not debt, and the key differentiation being that preferred equity, although it does have a priority in payout over common shares, is still an ownership stake in that project, and it is not money that has been lent into the deal. So whoever has invested that money, rather than lending the money on, let's say, a second charge as private debt, they've instead purchased shares in the company that's operating that deal. So it is therefore an ownership stake and therefore equity. Typically, preferred equity represents a silent investor, and they are on a different share class to that as the main people within the deal. And common equity is either created in the deal or is invested by the primary shareholders. So now that we understand the different layers within the capital stack, let's look at their associated risk. So I'm going to pop up an image on the screen, and in that you will see that the senior debt sits right at the bottom of the stack, taking up the biggest portion of the stack, followed by our second charge lending, which in this situation is shown as a mezzanine facility. We then switch into the equity side in the deal, where we then have our preferred equity, followed by common equity at the very top of the stack. You'll also notice that as we move up through the stack, the risk profile associated with that type of investment has also increased. So as we hit the top of the stack with common equity, that is the most at risk, whereas our senior debt or our first charge lending at the very base of the stack is the most secure. Now, the reason for this is because senior debt or our first charge lending, as we'll refer to it as, is most secure, and therefore it is the least risky. You're most likely to get your money back in a deal whereby you have invested on a first charge. This is because normally the loan to value to which you've lent, let's say it's 75%, which is a common loan to value a lot of banks will lend senior debt at, is only 75% of the value of the asset. And therefore, the argument is that in the event that the deal goes wrong, the bank has to recall that debt. They should quite easily be able to sell that asset and recall all of their funds, because at no point are they overgeared or overexposed in their lending. Now, as we move up into our second layer of debt, so our mezzanine facility or our second charge lending, you'll see that the risk profile increases slightly. Although it's still debt, you might think, well, why is that? Because they're both secured with a legal charge. The reason being that it's the priority in payout. So when, let's say we have a distressed asset that's got both first and second charge lending against it, and it sells at, let's say, auction for a discount because it's a quick sale for a distressed asset, first of all, the senior debt is cleared, and only once the senior debt is cleared and cleared in full do any of the remaining proceeds then move to the second charge. So in the event of the debt being recalled, there is a higher chance that the second charge may not get all of their money back because the asset may be sold quickly at auction, something like that, therefore not for its absolute maximum price. The first charge may be cleared, but that may not leave enough for the second charge to be cleared in full, and therefore the risk profile attached to second charge lending is higher than that of first charge lending. We then get into the equity layer in the stack, and within that we have our preferred and common equity. Now, our preferred equity is considered less risky than common, and this is because it has priority in payout. This is because in order for the common equity to receive any payout, the preferred equity must be paid back in full and the first return on investment hurdle reached before anything can be paid out. Once that hurdle has been met, the remaining equity left in the deal or the remaining profit in the deal can then be split between common equity and preferred equity as per their payout agreement or their shareholders agreement. The reason equity is risky because in the event that the deal goes south and there is no equity left in the deal, then there is no equity for anybody, preferred or common, and therefore everybody has lost their money. And you will also notice that as the risk profile within the capital stack increases, so does the return or the predicted return. So at the bottom of the stack with our first charge debt, in the context of property development, this might be our property development finance, and therefore the interest rates might sit at an average of sort of 9-10% as a fixed interest rate. As we then move up into our mezzanine facility, which is our second charge lending, the interest rate gets higher, and this is because the risk profile is higher. So here we see our interest rates sitting around 18 to 20%. So therefore, the person that's lending the second charge, although they're taking on more risk, if and when their money is paid back, they're getting a higher payback for it. Therefore, the risk and the reward balance works out. And then you'll see as we move up into the equity layer and the preferred equity layer, this is where the predicted return on investment gets significantly higher, north of 25% typically. However, you will notice I said the word predicted, and this is because, as mentioned before, if the deal goes south, there could be no money left in the deal, and therefore the return on investment could be zero. And it's quite simple to understand the reasons behind this one. It's simply risk and reward. The higher the risk associated with something, the higher the reward it demands. So as we move up the capital stack and a higher risk profile, we also receive a higher reward for it. So I hope this video made sense and helps you understand the capital stack in a bit more detail. If there's any other videos you guys want to see from me, drop a comment below and I'll be sure to do them in the future. Bye guys.